Welcome to TMS Insights, the December 2019 edition. Ben Clark and Jeremy Hook, aka Boris Johnson. I thought you might like my hair, but like it is. But
there were a few comments before the video.
Yeah. Unkind, but possibly on the money. And that's how we try to be here. But it's been a really good year for the share market, locally and overseas. There's been a lot going on. And I guess, Ben, to give people a sense of what might come about in 2020, it's actually quite useful to look back. This time last year, there was a lot of fear in the markets. There was a lot of concern about what lay ahead. And I think a really salient point after a strong year is to work out, that we've climbed the wall of worry of all these fears and dealt with them, and the share market's recorded, one of the best this decade.
Yeah, it couldn't be a more different feeling from when we were taking this in December last year. The market actually very nearly went into a bear market. It fell about 19% in Australia. There was talk of recession in America, recession in Australia, et cetera. And I still, pullbacks are completely normal. That was certainly a more severe pullback and a nastier one than we've seen in some time. But sticking through the cycle and making good decisions based on that, and having money to put in at times like that, which we were sort of discussing this time last year when we rewatched it.
Almost irrelevant to the big macro issues that dominate the headlines and make people scared, because most of those have been dealt with. I mean, trade war issues are still sort of going on. I'm thoroughly tired of people thinking Donald Trump's a negative influence on markets. It's almost been proven quite the opposite through the course of the presidency. Is almost irrelevant to the economic situation, which has been expanding throughout. But locally, the federal election here was important. And obviously, the UK election, the Brexit clarity that's now been achieved only recently. It's good for the market now and
Definitely.
It explains things.
And what has also been a bit different about the year that's passed is for the first time in many years, the Australian share market significantly outperformed other markets around the world. And I think a lot of that was to do with the election and also the rapid change in interest rate direction that we saw in this country, which has been a bit more extreme than in a lot of other countries, which already had quite low rates, but they haven't gone into that severe cutting cycle that we saw through 2019.
And that's left us with really something that investors, as we talk about over the holiday period, have to be careful in managing. And everybody's dealing with a low interest rate environment and the challenges that throws up for cash and secure investments. And we're just wanting to leave people with some thoughts about where to look, to be mindful that you can't re-engineer a high interest rate environment when it's in fact low. That's a fact.
Or if you are, you're taking on a lot more risk than you probably
And to that point, some of the riskier names that are being spruiked in the market to provide a high interest alternative are very risky. Names like Mayfair, for example.
Yeah, I mean, it feels a little bit like when we're headed into that 06-07 period. Certainly nowhere near as feverish, but there I think is just some signs of some people doing some silly things. And we've seen a record set of inflows into subprime mortgage lending in Australia in the last quarter. I think $4.3 billion went into that market in the last few months. So these mortgage funds have become very trendy. Debt funds, credit funds, however you want to term them. You've got to be careful. And it's often better to accept probably a bit more realistic return, investing in investment grade sort of stuff that's not going to get frozen, or it's not suddenly going to be worth materially less than what you think it could be.
So important what you just said, because these are the same signs we've seen 1986-7, 2006-7, like you said, and they end the same way. And they can only
it's history repeating, and you can see it starting to happen.
We don't want clients or people that our clients know to fall into the same traps that people in the past have made by seeking higher yield that doesn't have safety associated with it. And Ben, there is yield available in various things. Equities are yielding about 4%, REITs are yielding about 5%. We've been doing some work in the corporate bonds in the 3 to 4% zone. So there is available at the right risk scale some yield.
Yes, and at that scale you've got liquidity You've got great companies behind it, good structures behind it, and a very high probability that you'll get your money back on maturity. And if you made the decision to sort of sell them during that period, you'll be able to as well. So I think it's definitely a message for 2020, and I think the interest rate story generally is also going to be one of the defining sort of things for the share market in 2020. We have had an extraordinarily low period of wage growth and inflation, and the jobs data that came out of the US a couple of weeks ago, where their unemployment rate has now fallen to 3.5%, but they are still seeing no wage growth, quite remarkably, is something that we've never really seen before. No. So it's probably we've seen the RBA talking actually today and saying a period of very low rates is highly probable.
A long period,
but it's also sort of what the market's positioned for, and so some sort of breakout in inflation or something like that. Could be a reason we see some volatility return.
And even though we don't change our positioning, we just watch for those signs as they materialise, which they will inevitably. But I suppose we think pretty much the same way, that it'll take quite some time for those pressures to build. But we'll be watching out for them. But in summarising why the year was good, Ben, I think you put it there, that magnetic force, as Buffett calls it, of the power of low interest rates on higher equity prices.
Yes.
And we saw that this year. That's still a factor going into 2020 that supports equity valuations.
Yeah. And I think most clients would understand the logic that when your alternative cash rate falls, then more money goes into the share market, and that has been one thing driving the market higher. The thing I think is probably less understood is the relationship of how analysts value companies. They have to use an assumption of a discount rate, so discounting future cash flows into a net present value, which gives you a price target, which gives us all something to talk about and look at. And if you're using a lower discount rate, which they normally sort of correlate to bonds,
10-year bond, for example,
10-year bond yield, then you get a higher valuation in today's dollars. So it is completely logical.
Totally
for this to be happening.
And of course, the third thing really is the lower borrowing costs of companies that borrow, so their profits are naturally higher. So these are all good things. Ben, if we look out to the year just broadly, it's hard to take a great look at the whole year. I mean, I doubt that we'll have 4 good quarters. We'll see opportunities through the course of 2020. But we basically look at the year from an optimistic standpoint.
I think so. I for all the talk about, from the market commentators at the start of this year, there was a lot of doomsdays out there, but the one common line was there's going to be volatility. In fact, this has been one of the least volatile years we've seen. There's been virtually no corrections in this path higher. And I think we will get a return of that somewhat in 2020, more normal sort of 5 to 7% corrections through the year. I think the US presidential race will become a bigger thing as we get closer to that in the end of next year. And aside from that, it feels like some of the major hurdles for the market to keep moving higher have been removed, and I don't think we're going to see a rapid change in the interest rate outlook, which I think is probably the biggest risk factor to markets at the moment.
Yeah, definitely. Well, that's 2019 in summary. That's all we've got time for in this Insights. We wish all our clients, all our viewers, a Merry Christmas, and we look forward to bringing you more news of the markets in 2020.